This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Right, we're into illegalities, company law and F4, and there are half a dozen of these. There's wrongful trading and fraudulent trading, there's insider dealing, there's bribery. So there's more than just the occasional glance into illegal activities. So the first of them is wrongful trading, and you've got the notes in front of you. Previous law was extended by the Insolvency Act of 1986 before the current law, before the previous law was extended and was amended. It was difficult to establish that directors had been guilty of fraudulent trading. We'll come to fraudulent trading next, but wrongful trading was introduced by the 1986 Insolvency Act, and it took away quite a lot of the difficulty of establishing culpability on behalf of the directors. It's rather easier to establish wrongful trading than the previous criminal activity of fraudulent trading. So it brought more directors potentially into focus in terms of their illegal activities. The Insolvency Act is designed to give creditors protection. It's an example of lifting the veil because it was available for directors and company officers to hide behind the veil of incorporation and say, no, it wasn't us that did this. This was done by the company. This wasn't us that was carrying on trading. The company itself was doing the trading. Well, of course, companies, although they're people in law, they can't themselves carry on trading. It has to be, companies have to trade through the agency and the activities of directors and officers. So it's an example of lifting the veil, wrongful trading, as is also fraudulent trading. And the directors, and sometimes others too, officers that who do have responsibility and authority, may be held liable when the company has commenced an insolvent liquidation. Do you remember when we looked at liquidations? A solvent liquidation, a solvent liquidation, is available for the directors to pursue the route of a member's voluntary liquidation. Whereas if it were an insolvent liquidation, then it would have to be a creditor's voluntary liquidation. Now, if we pursue the member's voluntary liquidation, the major prerequisite of that being available to the company and to the directors is that the company is solvent. And then we can go down the member's route rather than down the creditor's route. But if we have any doubt at all about the ability of the company to pay its debts in full within 12 months of the commencement of the liquidation, if there is any doubt about that ability of the company, then we have to go down the insolvent route. And where a company commences an insolvent liquidation, we're back into the notes, then directors and others too may be held liable because they should have known. Liquidations of companies, financial difficulties don't happen like that. They don't happen overnight. And directors and officers should have known that the company was heading into a situation where they would not be able to continue viably as a company. So the companies commenced an insolvent liquidation. The directors knew, or they ought to have known, that this was probable and that they held a position of authority, typically a director. And if we can establish those, and those are not alternatives, those are not this or this or this, it's all three. That the company's commenced an insolvent liquidation, the directors should have known, and the directors, they are the ones that we're holding responsible for wrongful trading. The court may allocate financial penalty on the petition of a liquidator. The liquidator comes along, the liquidator and creditor's voluntary winding up comes along, collects the assets together, sees what's happening and thinks to themselves, the liquidator thinks to themselves and asks the directors and say, why, as a result of the financial position you were in 8 months ago, or 9 months, or in the recent past, Why did you continue? Why did you continue to trade when you should have known that the company was not likely to be able to pay its debts in full as you carried on trading, that you were going deeper and deeper and deeper into insolvency? Directors may escape liability if they can show the court that they did in fact, those directors did in fact take every step that was available to them to mitigate and to minimize the potential loss to creditors. If they can show that they genuinely made sincere attempts to resolve the financial crisis into which they were plunging, if they can do that, then the court may allow the directors to escape with just an admonishment, just a telling off. If they can show that they did everything reasonably possible within their abilities, then the court may forgive them. Forgive may be the wrong word, but the court may exonerate them from blame. The next one is fraudulent trading. And there are two offences under fraudulent trading. There's a civil offence and there's a criminal offence. The criminal offence is under the Companies Act 2006. The civil offence is under the Insolvency Act of 1986. And a criminal offence applies where a situation, when an entity has been set up, two situations actually, where it has been set up specifically to defraud creditors, or where it is, the second one, where it is being allowed to continue specifically to defraud creditors. So fraudulent trading is with the intention of defrauding creditors. So that's the criminal offence. And the penalty here is fine or imprisonment up to 10 years. These fines, these imprisonment periods may vary over a period of time. They're unlikely to be asked. They are unlikely in an F4 exam. The examiner is unlikely to say, what is the penalty? Is it 1 year, 5 years, 7 years, 10 years? It's unlikely to happen. The civil offence applies where the entity is being liquidated again, and where it becomes apparent that an entity has continued trading and the liquidator becomes aware of that fact, and then the liquidator can take action against anyone that the liquidator believes was knowingly a participant in allowing the company to continue. If they're found liable, the court may direct that those people should contribute to the deficiency of the company's assets in such amounts and at such times as the court may direct. Next one is money laundering. Whenever I look at money laundering, I'm reminded of my mother. There were a number of burglaries going on in the village where I lived, and the family was going on holiday. Mum, Dad, 2 sisters, me. I was only a small child, 6, 7 years old. And my dad had drawn some money out of the bank in preparation for going on holiday the day after. But he was aware of all these burglaries that had been happening in the village. So he slipped the £100, which was a lot of money in those days. He slipped the £100 into the pillowcase, and he was sleeping with his head on the pillow. And so if any burglar was going to rob us, they were going to be very lucky. They'd have to move my dad's head, take the pillow out, ferret it around inside the pillowcase. Anyway, we woke up in the morning, and my dad was in the bathroom, and Mum, in preparation for going on holiday, I thought, well, I'll just wash all the bedding. So she took all the pillowcases and the sheets and put them all into the washing machine and washed them all. And it was in the old days before washing machines emptied themselves into the main disposal water system. And so washing machines would empty themselves into the sink with an extendable hose you put into the sink. And my mum called up to my dad and said, Bert, what's all this green stuff in the sink coming out of the washing machine? And she'd washed the £100 note. She'd laundered the money. So the holiday was cancelled. Mum and Dad got some paper, some absorbent paper, and carefully unpicked these bits of pound notes that were available and put them on and tried to reconstruct them insofar as they were able. Did manage to reconstruct sufficient to the bank's satisfaction they did manage to reconstruct £83 out of this £100. So it's an expensive loss. £17 was a lot of money then. But they managed to reconstruct these sufficient to take them to the bank and say, look, there's the number of this one, and it's different from the number of that one. And they had 83 of these things on this absorbent paper to show to the bank. And the bank gave them the money back, but the holiday was cancelled. No way was I able to enjoy the holiday by the seaside because of my mother's money laundering activities. Anyway, here we go. The process whereby the proceeds of criminal activity are converted. If you're acquiring money through illegal activities, through dealing in drugs, and I'm not talking about a pharmacy here, through dealing in drugs, through prostitution, through dealing with any illegal source, if you yourself are accepting money from various sources in order to circumvent rules and regulations, if you're receiving bribes, then it's difficult to get rid of that money. You may think money is easy to get rid of, but I used to tell my clients it's one of the hardest things to do, is to get rid of cash. So it's no good hiding thousands and thousands of pounds worth of cash, or dollars worth, or whatever your local currency is, because it's difficult to get rid of. The revenue, should they get suspicious, can ask you, and do you smoke? How often do you go out? Do you go out to restaurants? When was your last holiday? Where did you go? Can we see your passport? Can we see your bank account? And they ask all this, and they work out and say, well, you have to have spent money. This money that you've been spending has to have come from somewhere, and it's not been declared in your tax return. So cash is a very, very difficult commodity to get rid of legally. So money laundering is ways in which cash from illegal sources is cleaned, dirty money therefore is cleaned and put back into the system. So although you pay tax on it, although you've got £5,000 worth of dirty money, and you wash it and you launder it and you put it back into the system, as for instance, the takings from the restaurant activity that you opened, the profits from the restaurant, even though you may not have a restaurant. You process this £5,000, you pay the tax on it, 25, 30, 40%, whatever, but at least you've then got 3,000 out of the 5,000, and it has the appearance of being clean money. It has the appearance of coming from a legitimate source. That's the concept of money laundering, and it's the way of converting dirty money into clean, and hence the expression laundering. So it involves three distinct phases. There's placement, where we place money into the business activity, a legitimate business activity, like a laundry or a restaurant, and you just therefore claim that these are the takings from the laundry, or from the restaurant, or from the legitimate business activity. Taxi driving, for instance, you just say, well, these are the fares that I've collected. And then the transfer of money from business to business or place to place, this is called layering. From business to business or place to place, making the cash trail more difficult to follow. So we get it paid from there to there, from here to there, and we move it around from organization to entity to different people, and we dissipate it from place to place. So it's extremely difficult to follow the cash trail. And then finally, integration, when we get it back from these various locations and we integrate it back into society. So having paid our tax on our 5,000 dirty money, we have now cleaned that money, and we're back again with 3,000 out of the 5,000 dirty. And so that's the process, is placement, layering, and integration. And there are three offences as a result of money laundering. If you're found guilty, or if you hear of somebody found guilty of money laundering, then there are three offences under which they may be found guilty. First of all, there's laundering. Laundering itself, the activity of following this procedure in order to clean up your dirty money. Secondly, there's a failure to report. These maximum 5 years prison and or fine. These are I suppose, variable. The other one, maximum 14 years prison or fine. They will vary from time to time. So these are not written in tablets of stone. So we've got laundering itself, which is a 14-year penalty and or a fine. We have the failure to report, which is a 15-year prison sentence and or a sorry, a 5-year prison sentence and or a fine. And lastly, the tipping off. Tipping off is an interesting one. Tipping off is a 5-year maximum penalty, and again with a fine. Now, failure to report is an offence, but failure to report only applies to people acting in professional capacities. So you, as an accountant or as an accountant supervisor, as an auditor, you may discover money laundering activities, and you would report them to the official within your firm or the manager within your firm or the partner within your firm. But the money laundering officer, and you'd say you're suspecting that your client is laundering money, is obtaining money from illegal sources and cleaning it up through apparently legitimate means in order to wash that money and bring it back into society. And if you suspect it and you report it to your money laundering officer within your firm, then your conscience is clear. It's then up to the firm, the manager stroke partner, to take action. And they should report this money laundering suspicions that you have. And if they don't, then they're guilty of failure to report. And if they fail to report, then they're facing the prospect of 5 years in prison and or a fine. Next one is insider dealing. There's some things to clear out of the way with reference to insider dealing. We need to think about the definitions of what is an insider, what is a deal, and what is it that they are dealing with. And insider dealing is an offence which relates to, first of all, it relates to insiders. And an insider is a person that has a connection with an entity, with a company, where it would be reasonable to assume that that connection would entitle them to access to sensitive information. That sensitive information I'll come to in a moment, but that's what an insider is, a person that has a connection with an entity and through that connection is likely to have access to sensitive information. A deal is buying or selling shares or securities within that entity that we're looking at. You can buy and sell shares in any other entity where you're not connected, but if you have a connection with a company and you buy or you sell or you encourage others to buy or sell shares in that entity, then you are dealing. You yourself are dealing, or you're enticing others to deal. And those are offences, those are criminal offences. If you hear through your work, for instance, if you recognize in the draft financial statements that your client quoted entity company has had better than anticipated results, and you're busy with access to all these financial statements and financial records, and you say, wow, haven't they done well? I don't think the stock exchange is aware of quite how well this company is doing. So you're in the situation of being an insider, where as a result of your connection with the company, you have access to privileged, sensitive information. If you go and buy shares in that entity in anticipation of the share price on the market increasing, if you hear that your client has got a takeover bid, as a takeover vulture has been approaching your client, and it's all very quiet, nobody knows about it yet, but you do. So you go and buy shares in anticipation of those shares increasing. You will be found out because investigations are carried out into takeovers, and you will be found out if you've been buying shares 2 days, 3 days, a week before the takeover is announced. So don't do it. Apart from anything else, you're an ethical person. You're ethical because you're trying to become an accountant, and accountants are ethical. You're honest. You're a decent, trustworthy person. So don't do it, because not only is it the end of your career, you're facing imprisonment, and it will not look good on any CV when you're trying to apply for another job. So prison service, prison sentencing does not look good when you're applying for jobs. Don't do it. It isn't worth the risk. So we've got an insider and we've dealt with dealing, but now we've got this expression, unpublished price-sensitive information. And this is the stuff, this is the sensitive information that I've mentioned a couple of times just in the last 5 minutes. The sensitive information has to be unpublished price-sensitive information, and it relates to our company. It's unpublished, that is, it's not in the public domain. It's not generally known to the public. And it's price sensitive, so that if it were to be generally known to the public, upon disclosure to the public, it is likely that publication of this price sensitive information will have a material impact on the market price of the shares or the securities of the entity involved. So that's unpublished and it's price sensitive and it's information, but that information must be less than, for it to qualify as unpublished price sensitive, it must be less than 6 months old. If the information is greater than 6 months old, or if it already is in the general domain, or if it's not likely to have a material impact, I'll come back to that, if it's not likely to have a material impact on the market price of the shares or securities, then it's not unpublished price sensitive information and therefore there's no guilt. Although you shouldn't, quite honestly, you shouldn't be making these disclosures of information that you've come across during the course of your professional career. How do you know and how do you determine materiality? How do you know what impact this information is going to have? I always found this a strange idea, a strange, I've lost the word, situation, that whenever I have held shares in the past, I held some shares in a company, and when the results were announced, the results were that they had recorded record profits, that they were increasing the dividend by 10% compared with the previous dividend, and that they were going to have a bonus issue so that we're all going to have a capitalization. They were going to debit share premium account and credit share capital. And we're all going to have this bonus issue of, I think it was 1 for 4. And that was wonderful. And the market price of the share, what do you think? Super profits, increased dividend, bonus issue capitalizing or debiting share premium account and crediting share capital of a 1 for 4 bonus issue for all these shareholders, and the share price went down. Why? Because the market had already anticipated. They already had anticipated record profits. They'd anticipated a 15% increase in the dividend, and so they were disappointed with just a 10%. And the bonus issue they had thought should be a 1 for 1 rather than a 1 for 4. And so the share price went down. Now, if I had been an auditor and I had known what was in the mind of the directors, and I'm sitting there thinking to myself, whoa, this is likely to have a material impact on the market price of the shares or securities. Now's the time I should be buying these shares to watch them rise up. And yet the share price went down. How can you possibly tell what the likely material impact is going to be on the disclosure of what is heretofore unpublished price-sensitive information? That's an issue, that's a problem. Now, there was an MP called Manny Shinwell. Many years ago, he was the father of the House of Parliament, the father of the House of Commons. And Manny Shinwell said when this insider dealing legislation was being proposed, he said, that's all very well. He said, but what is it within this legislation, this proposed legislation, that would make it an offence for you, during the course of your audit, to realise that the company is facing bad news and that when the information is disclosed, it's likely that the share price will fall? What is it that makes it an offence for you not to go and buy those shares? Because you're using that unpublished price-sensitive information to avoid making a loss. What is it also that when you realize that the results are good, and you already have shares, You're in connection with a company, either directly or indirectly, but you hear news that the results are good and you already hold shares. Why is it not an offence for you not to sell those shares? Because you're holding on and you're using that information to hold on to your investment, knowing from the inside information that the share price is going to go up. So 50% of the crimes are unaffected by this inside information, inside dealing legislation. Here's the offences. An insider in possession shouldn't deal. I made a mess of that, haven't I? An insider in possession shouldn't deal, which I think is relatively obvious. Shouldn't buy shares in anticipation of making a profit, shouldn't sell shares in order to avoid making a loss. A director of a company is clearly an insider. They're connected with the company and they're likely to have access to unpublished price-sensitive information. A director of a company is the classic insider, more so than the auditor. The director knows on a daily basis how well the company is doing. So a director in possession of this unpublished price-sensitive information should not themselves deal in those shares in order to make a profit or in order to avoid a loss. Directors can deal, they are entitled to deal and buy and sell shares in their company, but they have to disclose this fact, they have to disclose it to the stock exchange, and it's published, the information is published in the public domain. And there's a lot of transparency involved in companies, entities, price-quoted companies, giving information at the earliest possible opportunity into the public domain so that the risk of someone gaining an unfair advantage is minimized insofar as it is available to be minimized. An offence is also committed if the insider encourages another person to deal. Not tells them, but just encourages. Doesn't matter. If I am an insider, if I were an insider and I say to my sisters, you should be buying shares in this company, trust me, you should be buying shares. So it's an offence for me to encourage my sisters to buy shares or to sell their existing holdings in order to avoid a loss. So I've now committed two offences. I myself have bought to enjoy a profit, and I've also encouraged my sisters to buy so that they too, and that's me making the crime. So I've made the crime myself of dealing, committed the crime of encouraging others to deal. But an insider, the recipient of that knowledge, my sisters, if they deal, they are potentially liable also under the Insider Dealing Act. And they're liable if they knew or ought to have known that I was an insider. If they don't know that I'm connected with OpenTuition, if they're not aware of that connection, and I were to recommend that they buy shares in OpenTuition because we're doing so well, we would be if we were quoted on a stock exchange and if we charge money for our services. But if. So if I recommend to my sisters and they know that I was connected with OpenTuition, and they know that I'm a connected person, and they know, therefore, that I'm probably acting on unpublished price-sensitive information and passing it on, and they deal knowing that, then they too are criminally liable. So a person dealing as a result of encouragement and believing them to be an insider is also committing an offence. Disclosure of inside information other than in the proper course of information is also, course of employment, is also an offence. If you, in the course of your employment, you discover all this stuff about your client whilst you're out on audit, and you go back to the office and you say to the manager, I think you should be aware of what's happening. There were some very strange looking people there, and it looked like, and I recognize them from bigger companies, and it looks like there may be a takeover in the wind. And I looked in the minute book and it says that they'd had a visit from so-and-so company. You can disclose that to the office manager, to your group manager or your group partner in the audit firm. And that's acceptable. You're allowed to do that. Of course you are. That's what the purpose of your employment is to give information, full and frank and open, honest information to your superiors in order that they can make proper judgment. Some defences are available. I love this. Some defences are available. If you had thought that the publication of the unpublished price-sensitive information was not likely to have a material impact, then that would be a defence. I'm sorry, that's a very strange defence, isn't it? Another defence is if you sold shares that you already hold and shortly after the share price goes down, and it is shown that you are the holder of unpublished price-sensitive information and that you have a connection with the company, you can defend yourself by saying, but I did not sell those shares in order to avoid a loss. I was selling all my shares in all my companies in order to realize some money for a deposit for a house. Oh, yes. And did you buy the house? No, we tried, but by the time I'd realized all the money and was ready, the house had been sold, but we're still looking. So if you can show that you are motivated other than the avoidance of a loss or the making of a profit is a bit difficult, but the avoidance of a loss, then that would possibly be an appropriate and adequate defence. So there are defences available, but they're few and far between. And the more simple recommendation is don't do it.